Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Sonal Bhutra, and these are the top stories that we're tracking at 1:30 p.m. Midcaps outperform large cap peers in a volatile session. IT energy slides, banks gain.
Volta slips to trade near its 52-week low after bearish commentary and downgrades from analysts. The company shares have fallen the most since mid-September.
Steady performance and a bright outlook supports Dalmia Bharat. The worst is behind us, says the management at its conference call. It expects reasonable margin recovery in the coming quarters to outperform the industry on volumes.
M&M Financial jumps on a strong pickup in disbursals. The management tells CNBC-TV18 the company expects to maintain double-digit growth in assets under management.
Varun Beverages fires up after a strong Q2. The management says fourth quarter looks very promising. The company targets double-digit growth.
All right, those are the top headlines on Midcap Radar. A lot of stocks which are buzzing around on the back of earnings. But a quick look at the markets, and we have seen cuts of 55 points on the Nifty, but we have not fallen as badly as the SGX Nifty was indicating today. Global markets are also in a tizzy today. So compared to that, we are quite resilient. That's the word I would use. It's the Bank Nifty which is outperforming today, gains of 0.5% there, and Midcap side of things also doing well. But that is all about the broader markets and stocks as well. We have some companies on our radar as well. PDS, that is the stock in focus after its second quarter results. The company serves as a sourcing, manufacturing and supply chain platform for fashion brands. Its revenue was up 33%, while EBITDA margin was flat. To discuss this, we are joined by Sanjay Jain, who's the group CEO of the company. Mr. Jain, good afternoon. Thanks a lot for joining us. Well, you are a connecting link between customers and suppliers, and you provide them design capabilities, compliance assurance, and supply chain management as well. You have exposure, and substantial one at that, in the US markets and Europe markets as well. Considering the global setup that we are in, are you seeing that there is a drop in demand or drop in orders because you are a B2B player?
Well, on the whole, the global diaspora is impacted by the factors that we all are aware of, but the careful strategy the PDS has chosen, the careful mix that we have, on one hand, we are very well geographically spread, wherein close to 45% plus sales are from UK, about 25% from Europe, and about 16% from US. So we have a well-diversified geographical spread. On a category-wise as well, we have 41% men, 30% women. So because of this well-diversified portfolio, and PDS largely operates in low price segment. So as a result, whenever there is a pressure because of high inflation or interest rates, etc., there is a tendency to shift towards low price point. That also is, in a way benefiting PDS, wherein we have actually got a growth of 38% in the first half. And also, very importantly, PDS is careful about onboarding the customer that it chooses to do business with. Many of our customers are very well established, financially strong retailers. As a result, they remain to a large extent insulated from the global phenomena that we all are experiencing. So because of all these factors, yes, there is inflation, there is slowness, but PDS, because of its strategy, is carefully navigating ahead with a strong growth rate in the first 6 months.
Hasn't impacted demand, but do you have to give any discounts to the retailers because of this? Because you're talking about high inflation in the US, Europe also, as we are talking about, there is some pressure. So any discounts in place?
See, firstly, even right now in the midst of the third quarter, our order book continues to be strong. For example, about 6-7% of our top line comes from manufacturing. Both our factories are full with orders. Whatever growth momentum we have achieved, given the order book in hand, we anticipate that to continue in the near term as well. As regards the discounts that you're talking about, I think PDS strategy always is to go hand in hand with the customers. It's a more collaborative approach than actually a reactive approach. In fact, what is more important is that in the first 6 months, our EBITDA margins have actually improved 0.6%. So with the benefit of scale that the company has achieved, the benefit of moving towards a better diversified portfolio of the offerings, the margins have actually expanded. So as a result, to answer your question, through a collaborative approach, we work hand in hand, wherein if there is a situation that we have to offer discount, then that is more than commensurated by a larger share of wallet of working with that customer. That's a benefit of a collaborative approach than actually a reactive approach to a given market situation.
Sanjay, just one point, I know you have a lot of big global marquee retailers, but those, the Walmarts, Targets, Kohl, all of them have spoken about sitting on very high inventory because of which they had to do aggressive markdown to bring down that inventory in the last couple of months. That would have hurt you all right. And separately, if you could just give us an update on your debt and working capital, because I remember in the last quarter, both these two had shot up.
So, I think, yes, when you talk about the large US retailers, there have been pushbacks. There have been, an expectation of a price point reduction. But that's where, when I mentioned in the beginning, a well-spread geographical mix helps. At present, in the first 6 months, close to 16% of our sales come from the US market. So therefore, we have kind of on an overall portfolio basis, largely remain insulated as compared to any other company whose bulk of sales come from US market. That's answering your first point. On the second one, I think I'm very pleased to inform you that we continue to closely monitor our capital employed. We have managed to grow 38%, but our net working capital days remain same at 3 days, which were in Q1, as well as the end of Q2. And our net debt level are at 0.2 net debt to EBITDA level, which is a very, very comfortable leverage position. And important to add that all this net debt that we have on the balance sheet is working capital in the normal course of business. Our long-term debt lines are very insignificant. That's a benefit of the way PDS operates in a capital light model on the whole.
Okay. Mr. Jain, the last time you had spoken to us, you had said that to look at a company like yourself, we have to look at the return on capital employed. You had targeted 30% plus ROCE. By what is the current number? By when do you plan to achieve it? And on your plans of monetizing assets, why are you selling assets? There was a warehouse for around 50 crore rupees is what you had sold. Have you received it, the proceeds? And what are the plans with respect to monetizing non-core assets?
Firstly, we have already surpassed the 30% aspiration of return on capital employed. Basis of first 6 performance, the return on capital employed is actually 36%. So now the task is to keep maintaining it for all quarters to come. That's the first one. I think regarding the asset monetization, with the intent of staying core to being asset light, we identified that there were 2 properties in UK, which were, while warehousing logistics is important part of the supply chain the services that we offer, but rather than owning the assets on our balance sheet, we tend to take them on a long-term lease arrangement, or long-term, any kind of long-term arrangement. But in this case, the 2 properties that we had sold were actually being let out to third parties. So versus the rental yield as compared to monetization is what we have chosen. And in fact, last year when we did the monetization, we got a gain of 41 crore. And this year the gain is about 36 crore. So that's the intent behind monetizing them, because we were actually letting them out. And in fact, the cash so generated is being plowed back into the growth of the business or bringing the net debt down. I think we are largely done with the non-core asset monetization agenda. Whatever now remains are our some office infrastructures in Bangladesh, Hong Kong, or Gurgaon, which are inherent part of the core business. The objective would be to make sure that each and every square feet is gainfully utilized there.
One word answer, Sanjay. You had a target of being a $2.5 billion company. By which year will you achieve it?
We had said 5 years, from 1.2 last year to 2.5 billion. So 5 years is what we have. Average CAGR is about 15% over 5 years. The first 6 months is 38%. So
FY27 end, you should be a $2.5 billion company?
That's the aspiration with which we're working.
But you're clocking ahead of that. Thank you very much, Sanjay, for joining in. That's the word from PDS.
Okay, all right. So that is the stock update that we got you. For now, we'll do one thing. We'll slip into a short break. When we come back, we'll discuss more about the markets, and we'll also get in Mr. A.K. Das, who's the MD and CEO of Bank of India.